Welcome to the Money Huddle, a podcast that explores financial topics for families and small business owners. Hosted by Michael Baker and Ross Marinell. All opinions expressed by Michael and Ross or any podcast guests are solely their own opinions and may not reflect the opinions of Planners Alliance. The podcast recording is for informational purposes only and should not be relied upon for investment decisions. Clients of Planners Alliance may maintain positions in securities discussed on the program.
Welcome back to the Money Huddle. My name is Michael Baker, and I'm here with Ross Marinell. Ross, how are you today?
I'm doing good, man. How are you today, Michael?
Doing pretty awesome. Excited to talk about, I think we're going to talk about all kinds of cool stuff today. Start with the NFL draft, maybe?
So we've had a lot of activity in the IPO market in the last month.
IPOs, yes.
And have an idea how that might relate to the NFL draft a little bit, which just wrapped up. So excited to get rolling today.
What do you got for me?
Okay, so I think a lot of our listeners are probably familiar with the ride-sharing company LYFT.
Yes, okay.
So LYFT went public just about a month ago. It was the end of March 29th.
It's been that long already?
It has.
Okay.
It's been 30 days. So they initially listed for $72 a share. That was their IPO price. The stock popped to $88 and now has settled down to about $59 a share as we're recording today. So
who's madder, the people who bought at the initial price or the people who bought at the $80+ a share?
Well, listen, if you bought it at $88 a share and you're holding it at $59, you're down about 32%.
That's a wicked bear market.
From the IPO share price of $72, you're down about 18%.
Wow. Okay.
And so this prompted a couple of things. One was a couple of lawsuits have been filed against LYFT relating to their regulatory disclosure, the S1. And I think this is interesting. So the lawsuits are basically challenging a couple of the claims that LYFT made in their S1 filing relating to their U.S. market ride share. So LYFT stated they had about 39% of the share. There's some challenges to that, stating that maybe a little bit lower than that, and that may be the reason why the stock fell, or there's some.
So for those who are listening that don't know what rideshare is, that is the percentage of the, I guess, the riders that are using that type of service that actually opt for Lyft. Is that correct?
Correct. So they're looking at Lyft's share of the industry.
Okay.
Compared against, obviously, their largest competitor, which is Uber, which is about to file their own IPO.
Yes.
And so I thought that was interesting. So because the stock goes down, we're looking for reasons why, and we come up with the fact that, well, maybe their U.S. rideshare isn't as high as we thought it was, and a couple other small details that were included in that. And I thought it was interesting because, Michael, if you read the S1, it says some pretty incredible things under the risk category. So the S1 is a regulatory disclosure. You can find it on the SEC's website, sec.gov. And if you read that risk section, it is incredible.
Well, they do. I think they do a great job of putting those in plain language. There's not a lot of legalese, at least from my side of the table. It doesn't look like it's been just disclosed away. They're pretty straightforward.
It's really pretty clear. It's not. It's not like
we're trying to sugarcoat it,
where you need a dictionary out as you're combing through it. It's pretty clear. So there was the section related to risk. So it says risks related to our business. So this is LYFT basically telling investors, hey, here are some things that we see as concerning.
Sure.
You should know about it. And this one just caught my attention and I can't let go of it. It says, we have a history of net losses and we may not be able to achieve or maintain profitability in the future. Just let that sink in for a minute.
Yeah, so basically what they're saying is we have a history of not making money, and we don't, or I shouldn't say not making money. We have a history of not being profitable.
There you go.
And we don't necessarily think that we may ever be profitable.
That's right.
Possibly, maybe. Just depends.
Just to give a little context to our listeners, in 2018, LYFT recorded revenue of about $2.2 billion, strong growth numbers over the year before, but they also recorded a loss of $911 million. So they brought in $2.2 billion in revenue, but they actually lost $911 million. So even though they're doing significant revenue, they're losing money, and they're telling you in this disclaimer that they may not become profitable, they may not be able to maintain profitability. And as much as I would love to think that these folks that have lost money in this IPO deserve a fair shake, that what is leading to the IPO price or the price of Lyft today is complex. And I can't imagine that the understanding that they may not ever be profitable isn't a component of that.
Sure. Well, the thing about, an IPO is no one twists your arm and makes you go buy the stock. You as an investor, once it becomes public, with the IPO, which if you don't know what IPO means, it stands for initial public offering. So this is a security that until that point had been held. The shares were all privately held. They were not listed on an exchange. The IPO takes the security public. There is a public offering price. You can choose to pay and buy shares at that price, and a lot of people like to do that. And some of the big companies we've seen go public, can do well. A lot of them don't necessarily do well. It's kind of it truly is one of those speculative investments initially on, because a lot of things, when you become a publicly traded company, a lot of things are disclosed, whereas when you're privately held, you don't have to necessarily have all the disclosures to the public that you would normally. So it's an interesting take on it. For one, am not surprised at all that we have a lawsuit, simply because when you have people that make a speculative investment, and the way things seem to work nowadays is, well, it's not my fault, it's your fault, and I want my money back. It doesn't work that way. Not with investing.
So Bloomberg's headline from April 17th relating to the lawsuit: Lyft investors sue over slump, claiming IPO was overhyped. And as we know, you watch financial news media, CNBC, shows like that. They've got to fill 24 hours a day, 7 days a week of news, and an IPO is big news. And so it gets talked about incessantly. There's opinions being thrown around. And what you mentioned is really important, which is we have a short history with a lot of these companies that do file their stocks for the first time. There's not a lot of data that can be parsed through. It changes when they get listed and they have to start filing disclosures, and a lot of information comes to light. But in the beginning, we're really seeing a lot of the commentary is speculative in nature. They're just trying to extrapolate a lot of forward ideas on a limited set of information. And it does become just a talking point for a lot of purposes.
Well, of course. And, so if I were on the board at Lyft or any other company that's going public, I would be doing all of these things as well. I would be paying for, advertisement, or, I would be paying a PR firm to go out and drum up interest from the public. I would want as many people talking about the fact that we're getting ready to release our shares to the public as possible, because if you own shares or you're getting ready to try to sell shares of your company, take it public, you want as much interest as possible. So it's almost like these people they got caught up in the hype, and now they're finding out that a lot of it was hype, and they're mad, and now they want to sick the attorneys on the people at Lyft, saying it's all your fault, when Lyft completely told them. They told them in the S1, we have a history of not being profitable. We may never be profitable. I don't know how much plainer they can make it. So unless something just completely nefarious or very misleading that comes out down the road, I see these lawsuits going nowhere.
I think there were plenty of warning signs, but we'll see. We'll let the legal court. We'll see where this legal takes its course. But I thought this was interesting. So we have a lot of media hype and speculation and talk. We're just discussing it, right? We're getting expert opinions. And last week we had something I thought was very similar.
Oh, yes, we did.
Which is the NFL draft.
That's right.
And we have programs that run, it feels like all day, talking about these players. We're making projections. We're giving them draft grades. The draft analysis is in. We've got 500 mock drafts.
Right.
And we're basing all of these projections from what? 2-3 years of watching these young men play football in college.
In college.
I mean, the amount of data we have on who these people will be, who they'll become, where they get drafted, the organizations that they will learn from, and we're trying to project
There's so
their
many
career
variables
from maybe 18 months of history.
Right.
And so I thought it was interesting to think about. I wanted to read you a draft grade.
Let's hear it.
So I want to go back in time a little bit. All right, so this is the 2012 draft. I want our listeners to try and think of who I'm referring to.
So
here.
before you read it, just anybody that's listening that are scratching your head like, what is a draft grade? Obviously, one of the things that is well known or well documented throughout the build up to the draft is all of these analysts get together and they evaluate different players based on stats, history, programs, interviews, combines, and they start assigning them a grade. Like this player is he's rated at this number and this player's rated at this number, because their idea is to, create a mock draft where they say this player's rated so highly that we can't see him lasting past, the fifth pick in the first round. So that's what we're going to talk about.
All right, so I went back into the archives to find a couple of interesting draft analysis. Yeah. And so I ended up finding one. So the draft grade given to this player was a 95, I guess 95 out of 100.
Sure.
Which the way they refer to that is, this is, just to give you a little context, this is once in a lifetime player grade. Okay?
Once in a generation.
Once in a lifetime. All right. So it said these are his strengths.
He's a can't miss, right?
Right.
Can't
he
miss.
Is a talented quarterback who was built for the position. Although he is slightly undersized, his athletic ability lends well to him being able to be an NFL-type quarterback who can make plays with his feet, extend plays, and make the deep throw. All right. That's the strengths. The weaknesses for this player. He has a slight size deficiency and could have some durability issues if he is hit enough times. He anticipates plays so well and is able to react to a point where he should be able to avoid big hits even at the pro level. So I'm talking about a quarterback. 2012 draft. So, who am I talking about?
I know. I think it has to be RG3.
So that's RG3. So did he avoid big hits at the NFL pro
not
level?
Really.
No, kind of tore his knee up at the end of the first year.
And that's the thing. It's again, there is. You can do all your homework here's the thing. You can do all your homework, all your analysis, and still be wrong when it comes to drafting like an NFL player, right? These are people that eat, sleep, and breathe football. Could probably give you, I would imagine that every NFL franchise has a team of people that they lock in a box for months, and they study analytics and film and look at the combines and go do the interviews and go to the pro days, evaluating this talent. And it's still such a speculative, like who's going to pan out, who's not going to pan out. And imagine you've got a team that's dedicated that type of resources versus, we're comparing this to the LYFT IPO, where how many people just heard about it on CNBC and they wanted to get in on it. Didn't do any due diligence. They just wanted to this is the new IPO. This is the new hot thing. So let's invest.
Right. So like I was like we were talking earlier, the Washington Redskins who drafted RG3, they don't get to go and sue the draft analysts.
They don't get to go after Mel Kiper.
They had to do their own due diligence and homework, and they did, and they made a decision. It just didn't pan out.
Right.
That same draft, just for fun, there was another quarterback drafted that year.
Okay.
Besides my man Andrew Luck.
Andrew Luck,
he went number 1.
He's a stud too, by the way.
Was the 75th overall draft pick.
Okay. What did RG3 go number 1?
2.
He was number 2. So RG3 was the number 2 pick. This is the number.
So the 75th pick that year, the 6th quarterback drafted, I believe, was one Russell Wilson. Same year,
Wilson.
RG3 was given a draft grade of 95. Russell Wilson was given a draft grade of 68.5.
Wow.
Now, Russell Wilson, I believe, is now the highest paid player in the NFL.
He is. Now, whether he stays that way for long, but I think he did just sign the most lucrative contract in NFL history.
So you just never know. So
Right.
look, we're not owed stock market returns. Just because a company is available, just because somebody on TV is talking about it positively, it doesn't mean that we're going to automatically get investment returns. But it does mean that some of these, we should be doing as much of our own due diligence as possible. So as investors, if you're listening, if you're buying stocks on your own, do all the research you can, look at the regulatory filings, read the reports, find the things that you like and cause concern, and stay away from the things that might scare you away. Take advantage of the things that you think will do well, but we're not owed returns in the stock market. Sometimes the stock prices are going to go down.
And I would venture that for the lion's share of investors out there, folks that are trying to build retirement incomes, retirement savings, trying to build college funding accounts for their kids, investing in an individual stock is highly speculative just at its face value, right? Just at a face value, buying an individual stock versus a well-diversified fund, because with a stock, that type of choice, you get to be wrong once. But if you go and you invest in the sector, for example, or you invest in a fund that's going to have, hopefully hundreds of different positions, if one of those companies struggles, it's not going to derail your entire allocation. So, again, it's about being prudent. Now, I like to talk about individual companies just like anybody else, but when it comes to investing, we got to think big picture and how does this work for our overall plan? Get rich quick doesn't really happen in the markets. It's get rich slow, and taking a speculative bet and then watching it unravel in a span of 2 days has got to be very hard to take. So while no, I don't feel sorry for these people at all that they invested in Lyft, and hopefully anyone that's been reading the headlines will have learned from that when Uber gets ready to do its IPO.
Well, I tell you what, I'm assuming the Lyft investors are mad because their stock price is down, and who knows, by the time they ever get in the courtroom, who knows what the stock price could be.
Yeah, exactly.
It could be $10 a share, it could be $110 a share. Nobody knows. So
exactly.
All right, what else you got for us today, Michael?
Well, the next topic I think is something that we've talked about here, and we didn't have a chance to speak about it too much with Flint when he was in the studio with us the other week. Flint Foley, he came in, and Flint's a good friend of ours. He's a real estate agent here in the Charlotte area, and we talked about some neat stuff. So if you haven't listened to that episode yet, definitely give it a listen. He brings an interesting perspective to what's going on in the local real estate market, and also some of the technology that's starting to be available for people looking to buy a home. But one of the topics that gets floated a lot when we talk about financial planning and personal planning is this idea of, should I pay off my house early? What's the benefit? What's the pros, cons of paying down a mortgage versus the alternative, which could be saving money or putting that money to use in other areas? And that's one of the things we wanted to kind of dig into just a little bit, not a super complex dive, but definitely talk about it and give some ideas about the pros and cons of pursuing that strategy. And we thought, hey, with Ross's background in mortgages, what better person to lead that conversation for us?
So there's a few things that I think are interesting now when we look at, well, what should we do? Should we do a 30-year loan versus maybe a shorter term loan, like a 20, a 15? Something in that range, because I think folks, they certainly want to have those bills paid before they retire, maybe even before the real intense college expenses kick in. So maybe there's some urgency just from a timeline perspective to have the mortgage paid off sooner than later. And so I was looking at a 30-year fixed loan versus a 15-year fixed loan. The first thing that popped out to me was there's a little bit of the kind of flattening of the interest rate curve, meaning I think in the past, if you were evaluating a 30-year rate conventional mortgage loan versus a 15-year rate conventional mortgage loan, you would see a little greater discrepancy, meaning you'd have a little bit more incentive to do the shorter term loan just from an interest rate perspective.
Right.
And what is started to happen as interest rates have calmed down and 30-year rates are now around 4%, I was looking at some of the 15-year rates only being about 0.25% lower. So if you're looking at a 30-year fixed at 4% versus a 15-year fixed at, let's say, 3.75, maybe you could get a little bit less. Obviously, that's very individual, right, based on your credit and your loan to value and some things, specific to your loan. But that, just doing a sort of general view, the first thing that stood out to me was there's not a whole lot of difference between that 30-year loan interest rate and some of the shorter term loans that are available. So I took an example of a $300,000 loan. And just looking at the 4% 30-year loan, that's a mortgage payment of about $1,432. Okay,
Right.
Just hold that there for a thought.
Okay.
If you did the same $300,000 loan on a 15-year term at 3.75, you get a payment of $2,182. The difference is $750 a month,
Which is substantial.
It's not a small amount, but if you're thinking about, hey, should I be paying off my home loan faster, or should I be doing some other things with it? That's really the comparison I wanted to take, right?
Okay.
So if you wanted to say take a 30-year loan, but pay it off at the same pace as a 15-year loan, can you do that?
Yes.
Is that
That's the one thing that we tell people all the time. There's no law that says you can't pay your mortgage off early if you got a 30-year fixed loan. Now some mortgages may have a prepayment penalty. I can't imagine.
That's pretty rare these days.
I would say that sounds pretty archaic, but for the most part, we know a lot of people that obviously one of the more popular ways of trying to pay down a mortgage is you have a 30-year fix and you pay extra payments on it, trying to pay it down. So there's no reason why you can't do that.
Right. So just for perspective, if you took the 30-year loan and you just added the extra $750, the difference between the 15 and the 30, if you just added that to the payment, you would pay your loan off in 15 years and 4 months. So that's the difference, basically. If you made the same payment, the 15-year loan would be paid off 4 months sooner.
Okay.
But you are committing yourself
To that payment schedule.
15-year payment.
Yeah. Okay.
And if making that extra $750 a month payment is, let's say, a challenge some months,
Mm-hmm.
or you think you're at the upper end of your comfort level, why not take the 30-year loan and make that extra payment when you can,
Right.
and as often as you can? But in those months where maybe it's just not feasible, well, then you just pull it back.
Right.
Just pay your normal mortgage payment. I thought that was interesting that the advantage of doing the 15
4
year was
months.
only 4 months difference.
Right.
It just doesn't seem like that much time to really lock yourself into
Not
that
a huge
higher
incentive.
payment. So
No.
the second thing I wanted to do, and I thought this was kind of interesting too.
Okay.
So what if instead of making the extra payment toward the loan, what if we put it in that extra $750 difference into just an after-tax and non-retirement savings account?
Okay.
And so now I just said, all right, well, if you do $750 a month, that's $9,000 a year. You're saving in just a non-retirement account. We're putting it over on the side, and we're building a savings base that we're investing. Okay, and I used just a hypothetical return of 5%.
Okay.
So if you save $9,000 over 15 years,
Got 5%.
5%, at the end of that time, you have accumulated $194,207. So I'm just doing, as you know, straight line returns.
Sure.
We're not accounting for market swings, volatility, movement. We're just saying just
But
normal
even still, if you averaged 5% over time, I mean the return, the distribution of returns are going to be a little wonky, but the end number should be they're about the same.
That's right. So here's something I wanted to share. If you just made your normal 30-year mortgage payment 15 years down the road, you know what your balance would be?
I have no idea.
$192,842.
The plot thickens.
So, in theory, quote unquote, you could potentially just put that money aside in a savings account, let it grow, and if you decided 15 years down the road, hey, look, I want to be debt free, I want to have this mortgage paid, it's possible you could have the account there.
Right.
Now, you may get to that point and decide you don't want to do that, but you now have the choice. So the only thing that's hard for us to kind of project there is the tax drag of having a non-qualified account. So you got to account for capital gains. You got to account for dividends and interest being taxable. So that's kind of why I try to use a realistic return number.
It's a fair number. I mean, obviously we could get into the weeds on, dividends and interest and tax losses and cap gains and what your tax strategy is going to be. But I mean, I think the general idea is to say, hey, look, if you were disciplined and you took that same, that excess payment, if you will, or that extra funds that you had available, and instead of applying them to your mortgage, but you invested them and saved them, and you got, which I think is a reasonable rate of return, 5%, that at the end of your 15-year schedule for your mortgage, you'd still have this balance of 192,000 and some change, but you could also have an account with 194, 193,000 that you could, if you chose to, go and pay your mortgage off.
Right. Now, the question is, can we stick to that for 15 years? One of the reasons why there's so much home equity wealth at retirement for people is, look, they've been making payments, right? I mean, we pay our mortgage every month. It's just a fixed part of our lifestyle, right? The mortgage gets paid. The consequences are too dire to not pay it. But we don't always pay ourselves after the fact, meaning if we were just to try and say, hey, we're going to save $750 a month, well, maybe we do some months, maybe some months we don't, right? Maybe some months we go on vacation.
That's probably more realistic.
We just spend a little bit more.
Sure.
And so I think depending on, like you said, the commitment, your ability to being able to commit to it would probably lend in making your decision there.
No, without a doubt. I actually read an article that I think was very similar and it had some great questions. This is Ben Carlson wrote an article, and the title of it was "What's the Return on Mortgage Prepayments?" And if you want, we'll put a link to that article in the show notes. But one of the things that he pointed out actually was right exactly. He used basically the same data that you pulled out as far as a $300,000 mortgage, and then he did some analysis on what if you made one additional payment, or one additional annual payment, how does that reduce your loan or the length of the loan? He talked about putting a big $30,000 lump sum prepayment in and how that would reduce the loan. And for me, what I have looked at is with as much as people move nowadays, or you change homes,
right?
It seems to me that I personally would value liquidity and having cash or liquid resources available to me than having all of my capital tied up and trying to pay off a home, when it's very possible that I may want to move out of that neighborhood in the next, or I may need to relocate for a job. I mean, that's the way that a lot of families are nowadays. I can't remember, Flint told us, but the average,
it's
person,
like 4 years.
Yeah,
it's
like
short.
The average length of stay in people in a home nowadays is 4 to 5 years, I think. So for me, like, while the idea of being debt-free and paying off a mortgage is definitely sound, and I know that there are a lot of financial gurus out there that they pound that drum pretty hard about get your mortgage paid off. However, a couple of things have happened. One, with the tax reform that we just had, the standard deduction for married couples has doubled to over to $24,000. Where for a lot of people that are now were able to itemize, can't necessarily itemize their interest, on their mortgages. So that changes the dynamics of home buying slightly. I've never been one to advocate that the reason you buy a home is because the interest was tax deductible. You buy a home because you need a place to live, and hopefully you choose wisely and you don't buy too much house. So kind of to bring it full circle, when I go back to what you were initially talking about, your mortgage, I think what I would imagine what a good portion of people do is they go with the 30-year fix because it gives them the most affordable or cash flow friendly payment.
Sure.
Because they want that extra. If they could afford a 15-year and they look at a 15-year and a 30-year, they're like, well, we're paying $700 something less a month. We don't know if we're going to be here long term. This is not our forever home. What will we do? So what I think the second side of that is can you be disciplined enough to not spend that extra money? And I think that's where the rubber meets the road for a lot of people. If you're going to have this extra money, don't go lifestyle it away. Make sure you're being disciplined in saving it or investing it, because of the two scenarios that you shared with me, if I've gone 15 years and I've paid my mortgage and I haven't had problems. Haven't had problems paying my mortgage. I've been able to cash flow it nicely, and I've also been disciplined and I'm saving. I've gone 15 years and now I might have almost $200,000 in an investment, set aside.
Right.
Where if I want to go pay my mortgage tomorrow, I just go pay my mortgage. Or I could just keep rolling and keep doing the same thing. Right?
Right.
So to me, that's a scenario that I like the most versus putting all my capital in a home, because we see that when we work with people that retire all the time, and we do see a good share of couples that come in here who are very constrained with their retirement resources for money that's in a retirement plan or investable assets, and some of it's not always their fault. Sometimes there was a life event, something happened, someone got sick, and it cost them a lot of their financial resources. And here they are, they have this house that's worth $500,000 because of the area that they live in.
Right.
And as much as that's great that we have a $500,000 home, that home is not going to pay bills. It's going to have bills.
Right.
And so we're having to now have conversations about, well, how do we effectively downsize, or can we effectively downsize? Right?
Well, yeah, I agree. I think if for our younger listeners, if we were prioritizing where do we put the extra resources, the home loan is not the first source, right? So we've got to make sure, one, we have a comfortable emergency fund. That's got to be the first step.
Exactly.
Getting rolling with any extra payments. We got to make sure we don't have any credit card debt, because we don't want to have 12, 13, 15% revolving debt.
Credit. Yep.
So those two things get knocked off. Then we look to the third pecking order, right? Are we funding retirement plans through your employer? Are you taking advantage of company matches? Are you taking advantage of, let's say maybe you have an HSA account that you could use to help offset medical costs? Are we taking advantage of all the employer benefits and related savings accounts there? And if we're hitting those numbers and we've got the cash reserve and there's no other more pressing debt, then I think you look at, all right, how do we advance payments on the home loan? And that's when I would start looking at these types of scenarios, where I would start doing some amortization calculations on, hey, here's how much I owe. Here's the time frame I want to have it paid off in. There's a couple ways to do it, right? You could just go get a term loan that matches that. If it's a 10 or 15 year, that's fine.
Sure.
Or you could look at, hey, all right, how many extra payments do I need to make on top of what I'm doing now to get there? And find a way that's right for you. But I do think that sometimes we put paying the home off as priority 1, when really maybe it's priority 10.
Right. It is, and it's it's preached a lot of get the mortgage paid, and there's nothing wrong with having that as a priority, because if we can leave the workforce or get ourselves debt free, I mean that does open up a lot of flexibility with a financial plan. But at the same time, it's like, I value having liquid assets and assets available to me, not just everything's tied up in my home, because that home may not grow at the rate that we think it would. I mean, there's all kinds of scenarios, and so one of the priorities that we love when we talk about planning is having flexibility and being able to sit down year in, year out and determine where's the best place for me to put this extra money. There may be an investment opportunity that comes up that would be wonderful, but we don't have any money to invest. There could be an opportunity. The tax code may shift again, where there are new types of accounts that are available, but we don't have any way to fund them. Or we have to completely unwind some things that we've been doing. So I think the key here is that while that's a great rule of thumb, if you will, in the financial world, it shouldn't be uniformly applied, because for some households, it's going to make a lot of sense. Hey, you need to pay this mortgage off and get it off, or pay this debt off as quickly as possible, because these are your goals. For other households, there may be a better way to allocate that cash flow for the long term. So I think it's a great topic. It's definitely one that will continually be debated and written about. What we are always looking for, folks to give us, things to discuss and questions on the program. So I'm going to give a shout out to my friend Dave, who actually submitted that to us through our Facebook page. He wanted to know, us to talk a little bit about the pros and cons of paying off a mortgage early. I mean, we think that, especially for younger families, there are other things that we think we might want to prioritize a little more. But again, financial planning and personal finance is more personal than it is finance a lot of times. And so it's worthwhile sitting down and having a conversation to see what makes the most sense for you.
Absolutely. I think that's a good way to wrap it up.
Perfect.
And appreciate it. It was fun today.
It was. And, as always, thank you for listening. If you got a question or if there is a topic that you would like us to discuss here on the podcast, feel free to drop us an email. Our email address is the Money Huddle. That's themoneyhuddle@vcplanning.com. And as always, thank you for listening. We'll talk to you next time.